There is a pattern in the machinery of the global economy. It is a rhythm that beats with terrifying precision. It does not happen every year. It does not even happen every decade. It happens only when a specific set of conditions align perfectly. These conditions are extreme asset valuations, record levels of debt, excessive leverage in the banking system, and a widespread, almost religious belief that this time is different. These conditions existed in 1929. They existed in 2008. And right now, as we move through 2025, every single one of these conditions exists again. But this time, the scale is larger. The leverage is higher. And the interconnection between global markets is deeper than ever before. The stage is set. The actors are in position. And if history is any guide, the curtain will fall on this economic era in late 2026 or early 2027. This is not a prophecy. This is not fear-mongering. This is pattern recognition. What you are about to see is a documentary analysis of a crash that has not happened yet, but which follows a script that has been written by centuries of financial history. We are going to show you exactly how the crash unfolds. We are going to show you who loses everything. We are going to show you who profits enormously. And we are going to explain why the crash of 2026 will likely be worse than 1929 and 2008 combined. We must begin by understanding where we are right now. We are currently living inside the everything bubble. In 1929, it was a stock market bubble. In 2008, it was a housing market bubble. Today, it is everything. Real estate in major cities is at all-time highs. The median home price in America is completely disconnected from the median income. Historically, a sustainable ratio of home price to income is 3-to-1. Today, it is over 5-to-1. Housing is nearly 90% overvalued relative to the wages of the people who are supposed to buy it. Corporate debt is at record levels. Non-financial corporate debt in the United States has reached $13.5 trillion. That is 72% of the gross domestic product. Before the 2008 crisis, it was only 43%. Corporations are more leveraged now than they were before the last financial disaster. Government debt is $36 trillion. Interest payments alone are approaching $1 trillion annually. And consumer debt, credit cards, auto loans, student loans totals over $17 trillion. When you add it all up, the total debt in the United States economy exceeds $90 trillion. Every sector is leveraged beyond historical norms simultaneously. Why did this happen? For 15 years, since the crisis of 2008, the Federal Reserve guaranteed that asset prices would only go up. They suppressed interest rates to zero. They printed over $8 trillion. They taught investors a simple, dangerous lesson. Buy the dip, because the central bank will save you. This conditioning created a massive moral hazard. No one fears risk because they believe risk has been eliminated by the government. But there is a fatal flaw in this belief. The Federal Reserve has used up its ammunition. In 2008, they could cut interest rates from 5% to 0. Today, rates are already relatively low historically, and inflation is lurking in the background. They print trillions of dollars again to save the market. They risk triggering hyperinflation. If they do not print, the debt deflation creates a depression. They are trapped. And when the central bank is trapped, the bubble has no safety net. Now, let us look at the timeline. How do we get from the everything bubble of 2025 to the great collapse of 2026? We can predict this because the pattern of a crash is always the same. It moves through 5 distinct phases. Phase 1. The trigger. Every avalanche starts with a single snowflake. But in economics, the snowflake is usually a specific sector that breaks under the pressure of interest rates. The most likely trigger for the 2026 crash is commercial real estate. Right now, office buildings across the United States are sitting 40 to 50% vacant. This is a structural change caused by remote work. It is not going away. But the debt attached to these buildings is still there. Over $2 trillion in commercial mortgages will mature between 2025 and 2027. These loans were taken out when interest rates were 3%. Now, they must be refinanced at 7 or 8%. The math simply does not work. A building that is half empty cannot pay an 8% mortgage. We are already seeing the cracks. Major owners like Brookfield and Blackstone are beginning to strategically default on office towers. They are handing the keys back to the banks. This leads to the second part of the trigger. The regional banks. Small and mid-sized banks hold the majority of this toxic commercial real estate debt. When the building owners default, the banks take the loss. We saw a preview of this in 2023 with the collapse of Silicon Valley Bank and First Republic. That was the tremor. The earthquake is coming. If commercial real estate defaults accelerate in late 2025, we could see 50 to 100 regional banks fail in a matter of months. This would freeze lending across the entire economy. Phase 2, the false recovery. This is the most dangerous phase. After the initial shock of the bank failures, the government will intervene. They always do. The Federal Reserve will announce a new liquidity program. The politicians will promise bailouts. The stock market will rally. In 1929, after the initial drop in October, the market recovered for a week. People thought the worst was over. In 2008, after Bear Stearns collapsed in March, the market rallied for months. Everyone thought the crisis was contained. In early 2026, we will likely see a false spring. The media will tell you that the banking crisis has been solved. They will tell you that the soft landing has been achieved. Investors, conditioned to buy the dip, will rush back into the market. This false recovery draws in the last of the suckers. It convinces the middle class to keep their money in the market right before the floor falls out. Phase 3, the cascade. This is when the real crash begins. It usually happens in the fall. 1929 crash, October 2008 crash, September. In late 2026, the weight of the debt will finally become too much. It will likely start with a major corporate bankruptcy. A household name company, perhaps a legacy automaker, or a highly leveraged tech firm will miss a debt payment. This will spook the bond market. Bond investors will realize that if a Fortune 500 company can fail, no one is safe. They will stop lending. When the bond market freezes, the economy stops. Companies cannot make payroll. They cannot buy inventory. They begin to lay off workers by the thousands. As unemployment rises, consumers stop spending. When consumers stop spending, corporate earnings collapse. When earnings collapse, stock prices crash. This is the feedback loop. It is a spiral of destruction. In 1929, this cascade lasted for 3 years. In 2008, it happened in 6 months. In 2026, because of high-frequency trading and the speed of information, it could happen in weeks. We could see the S&P 500 fall by 30, 40, or 50% in a very short window. Trillions of dollars of paper wealth will evaporate. Phase 4, maximum panic. This is the bottom. This is the point of maximum despair. In our timeline, this lands in mid to late 2027. At this point, the news will be apocalyptic. Unemployment will be hitting double digits. There will be social unrest. Pension funds will be announcing that they are underfunded. This is when the average person sells. They look at their 401k, which has lost half its value, and they panic. They sell at the absolute bottom, locking in their losses forever. But this is also the moment of maximum opportunity for the prepared. Phase 5, the reset. The government, facing a total depression, will have no choice but to change the rules of the game. In 1933, Roosevelt confiscated gold and devalued the dollar. In 2008, the Federal Reserve invented quantitative easing. In 2027, the response will likely be yield curve control and central bank digital currencies. To save the system, the Federal Reserve will print money to buy the government's own debt. This will stabilize the bond market. but it will permanently devalue the currency. It will be the beginning of a new inflationary era. Now that we have the timeline, we must ask the critical question, who loses and who wins? A crash is not the destruction of wealth. It is the transfer of wealth. The buildings are still standing. The factories are still there. The land is still fertile. The ownership simply changes hands. Who gets destroyed? The middle-class saver. The person who followed the traditional advice. They put their money in a diversified portfolio of stocks and bonds. In this crash, both stocks and bonds will likely fall together, just as they did in 2022. There will be nowhere to hide in traditional paper assets. The leveraged homeowner, people who bought houses at the peak of the market in 2024 and 2025. When the recession hits and people lose jobs, forced selling begins. Housing prices will correct. If you put 5% down on a house and the value drops 20%, you are underwater. You are trapped in a mortgage for a house that is worth less than you. The passive pensioner, retirees relying on fixed income. Inflation will eat away the purchasing power of their checks, while the crash destroys the principal of their savings. Who profits? The cash holder. Cash is trash during a bubble, but it is king during a crash. If you hold cash while the market falls 50%, you have effectively doubled your purchasing power. You can walk into the ruins of the market and buy assets for pennies on the dollar. Warren Buffett is currently holding over $300 billion in cash. He is not stupid. He is waiting. The gold owner. When the Federal Reserve pivots to save the system in Phase 5, they will print trillions. This debases the dollar. Gold acts as the inverse of confidence in the central bank. In the recovery following 2008, gold nearly tripled in price. In the recovery following 2026, it could go much higher. The short seller. The investors who identify the weak links, the zombie companies. The regional banks, the commercial real estate trust, and bet against them. This is high risk, but it created billionaires in 2008. The distressed asset buyer. Private equity firms are already raising billions of dollars in dry powder. They are waiting for the commercial real estate market to collapse so they can buy office buildings and apartment complexes at auction prices. They will buy the assets from the bankrupt banks, hold them for 5 years, and sell them for massive profits. Let us compare the 2026 crash directly to its predecessors to understand the magnitude. Compared to 1929, in 1929, the stock market capitalization was $80 billion. Today, it is over $50 trillion. The scale of wealth destruction will be unimaginable. The 1929 crash was deflationary. Prices fell. The 2026 crash will likely be inflationary in terms of the cost of living, even as asset prices fall. This is stagflation, and it is much harder for the average family to survive. Compared to 2008. In 2008, the crisis was centered on residential housing. It was a problem of bad mortgages. In 2026, the problem is sovereign debt. It is the government itself that is the subprime borrower. In 2008, the U.S. government had a debt-to-GDP ratio of 60%. Today, it is 120%. When the government is this indebted, it has less capacity to bail out the economy. In 2008, the government bailed out the banks. In 2026, who will bail out the government? The answer is the currency. They will sacrifice the value of the dollar to save the bond market. So, what should you do with this information? First, you must accept that the cycle is real. You cannot wish it away. The debt must be paid, either through default or through devaluation. There is no third option. Second, you must look at your own exposure. If you are 100% invested in the stock market, you are betting that the everything bubble will last forever. That is a dangerous bet. Third, you must prepare psychologically. The hardest thing to do in investing is to act against the herd. Right now, the herd is greedy. In 2026, the herd will be fearful. You need to have the discipline to be defensive now, so you can be aggressive then. Consider reducing your debt. If a recession comes and your income is threatened, you do not want to be servicing high-interest loans. Consider building a position in hard assets. Gold, silver, land. Things that cannot be printed by a desperate central bank. Consider learning a skill that is recession-proof. In a depression, the most valuable asset is your ability to solve problems that people are willing to pay for. The documentary of the future is being written right now. The data points are accumulating. The commercial real estate vacancies, the rising delinquencies on credit cards, the inverted yield curve, these are the warning signs. Most people will ignore them. They will watch the stock market hit new highs and assume everything is fine. They will be the ones who are shocked when the music stops. But you do not have to be one of them. You have the information. You can see the pattern. The crash of 2026 is coming. It is a mathematical inevitability born from 15 years of financial excess. It will be a time of great hardship for many, but it will also be a time of great opportunity for those who are prepared. The wealth of the world is about to change hands. Which side of the transaction will you be on? If this analysis has helped you see the economic horizon more clearly, please subscribe to this channel. We are dedicated to tracking this timeline week by week. We do not sell fear, we sell preparation. In our next video, we are going to dive deep into the specific list of safe haven assets that historically perform best during a stagflationary collapse. We will look at the data from the 1970s and the 1940s to build a portfolio that can survive the storm. You do not want to miss that. The clock is ticking. The year 2026 is closer than you think. Stay watching. Stay prepared.